Welcome to the Deep Dive, your shortcut to getting truly well-informed. We unpack complex info, grab the most important nuggets, and turn them into, well, surprising facts and insights you can actually use.
And today we're diving into a really interesting story. It's about resilience, about strategic thinking within India's auto sector, which is always moving, always changing.
That's right. We're looking at PPAP Automotive Ltd, a key player, right, in auto components.
Exactly. We've got the transcript from their latest Q1 FY26 earnings call. And our mission, really, for you, the listener, is to pull back the curtain. Understand their recent performance, sure, but also get a feel for the wider industry outlook, what future trends they're watching, and crucially, the risks they're managing.
It's a great way to see how a company actually navigates, the real world.
Definitely. Is always fascinating.
Okay, so let's start with the big picture. Q1 FY26. What did the overall Indian auto landscape look like then? The earnings call mentioned a general sales decline.
Yeah, that's the headline. Overall, across all vehicle types, sales were down about 5.1%. Not a crash, but definitely a noticeable dip.
5%. Okay. But I guess the story's a bit more complicated when you break it down.
It absolutely is. And this is where it gets interesting. It paints a more nuanced picture. Passenger vehicles, or PVs, they dipped, but only by about 1.4% year-on-year, relatively modest.
Okay.
But then you look at two-wheelers, sales there contracted much more sharply, over 6%. 6.2%, actually.
Wow, quite a difference.
Huge difference. And commercial vehicles, trucks and buses, they were also down about 5.6%. The only tiny bright spot was three-wheelers, which were up just like 0.1%, basically flat.
So PV's holding up better than bikes and commercial vehicles. What does that sort of tell us?
Well, it's fascinating, isn't it? It suggests maybe a bit of a split in the market. Larger purchases, like family cars, might be holding steady, relatively speaking.
Yeah.
Whereas things like two-wheelers may be more sensitive to immediate economic pressures, fuel prices, that kind of thing, saw a bigger hit.
Right, so a challenging environment overall, but affecting different segments differently.
Precisely. It sets the stage for understanding how a component supplier like PPAP would fare.
Okay, so with that backdrop, how did PPAP Automotive actually do in Q1? Did their numbers reflect that softness?
They did. Their consolidated revenue from operations, it declined by 4.9% year-on-year, came in at 116.6 crores.
And just quickly, for our listeners maybe not familiar, a crore is 10 million rupees, so 116.6 crores is what, about 1.16 billion rupees?
That's right, roughly, yeah. Or around 14 million US dollars, give or take. So on the surface, that 4.9% decline, it mirrors that general industry softness we just talked about.
And did they give reasons for this dip on the call?
They did, yeah. Two main things they pointed to. First was simply that subdued market demand, which fits the industry numbers.
Okay.
Second, and this is pretty important for them, was the deferment of some project launches by their main customers, the big car manufacturers, the OEMs.
Ah, so new models getting pushed back.
Exactly. They also mentioned, that Q1 is often a seasonally soft quarter for them anyway. So maybe a bit of a perfect storm, usual seasonality plus weaker demand plus those launch delays.
Right. And that must have hit their production lines, too. I think they mentioned capacity utilization.
Yeah, they did. In their main parts business, capacity utilization was down to 62%, which, as they said, reflects those lower volumes and also somewhat irregular order flows from their big customers during the quarter.
Okay, so let's unpack this. The initial picture looks a bit tough, maybe, but there's clearly context behind it.
Definitely context. They're operating in that wider slow market, but also dealing with very specific customer timing issues. It's not just about overall car sales figures.
Right. So Q1 was Q1. What about the road ahead? Is the industry expecting things to pick up? And how does PP see the rest of the year?
Well, the general industry outlook, especially for the second half of the financial year, what they call P2, is, I'd say, cautiously optimistic.
Cautiously optimistic. What are they basing that on?
A few key things. Expectations of a normal monsoon season, always huge for demand in India, particularly rural demand.
Sure.
Then there's the festive season coming up later in the year, which usually sees a big jump in sales.
Always a big factor.
And finally, they mentioned accommodative monetary policy. Basically, the idea that borrowing costs might stay reasonable, making it easier for people to finance big purchases like cars. So some potential tailwinds.
Okay, so the industry's cautious, but hopeful. But PPAP themselves, they sounded pretty confident, didn't they, about hitting their full-year guidance of 600 cores revenue for FY26? After that slow Q1, that seems, well, bold.
It does sound bold, but this is where their explanation gets really interesting. Their confidence isn't just wishful thinking. They said it stems from seeing strong sales already in July and August, remember, that's after Q1 ended,
Ah, okay. So they're seeing a rebound already.
across all their business segments, apparently, not just auto parts. And critically, remember those delayed model launches that hurt Q1? They stressed that those delays were customer-driven. It wasn't PPP not being ready. The projects just got pushed into Q2 and Q3 by the car makers.
I see. So the orders are still there, just shifted.
Exactly. They firmly believe that once those delayed projects ramp up to the volumes originally planned, they'll be right back on track for that 600 crore target. It's all about the timing of those OEM launches.
Okay, that makes more sense. It's not just hoping for the market to turn around. It's about specific known business coming online.
Precisely. And they're not just waiting for orders either. They mentioned they're actively tracking key market trends.
Like what?
Things like, the huge popularity of SUVs. That's a big shift. Also, market share gains by domestic players like Tata and Hendra. They're watching who's winning. And of course, the big one, the growing role of electric vehicles, EVs.
So they're trying to align their strategy with where the market is actually going.
Seems like it. They specifically said their new business efforts are aligned with these trends, but their core, the automotive parts business, that remains, in their words, the primary growth engine.
Right, the bread and butter. So what's the strategy there? How do they plan to grow that core business, especially if the overall market is just okay?
It's quite a smart multi-layered approach. First, they're focusing on increasing content per vehicle.
Meaning selling more parts for each car.
Exactly. Or selling more complex, higher value parts for each car. So even if total car sales are flat, PPP's revenue per car goes up. It's a good way to grow.
Makes sense.
They're also pushing higher value-added products generally and trying to broaden their customer base, making sure they're supplying to both traditional ICE internal combustion engine vehicles and the growing EV segment.
Diversifying within the core auto business itself.
Right. And the proof seems to be in the order book. They highlighted a secured lifetime order book of, get this, 3,439 crores.
Wow, that's huge. What does lifetime order book mean exactly?
It basically means confirmed orders for parts for the entire expected life of certain vehicle models. So it gives them, as they put it, healthy revenue visibility for the next, say, 3 to 5 years.
That's significant long-term visibility.
Very significant. And even in that soft Q1, they secured new orders worth 86 crores. And interestingly, 11 crores of that was specifically for EV programs.
Okay, so they're definitely getting traction in the EV space too. Who are their biggest customers driving this order book?
Well, reflecting in the Indian market, Maruti Suzuki, along with SMG, is their top customer. They hold, over 50% market share in cars in India?
Yeah, massive player.
Then Tata Motors is now their second biggest,
Mm-hmm.
which is really interesting. Shows Tata's recent growth surge. And Honda is third. So their order book really aligns with who the market leaders are.
And what about profitability in Q1? Margins must have taken a hit with lower utilization.
They did acknowledge that subdued margins were mainly due to that lower capacity use and lower sales volume. It wasn't, they said, about rising costs or anything fundamental like that.
Okay.
In fact, they stated that operationally, the margin profile is actually getting better, and they expect to get back to double-digit margins for the rest of the financial year, the remaining 9 months.
That's positive. Any supply chain issues mentioned? That seems to be a constant worry these days.
Surprisingly, no. They explicitly said they faced no supply chain challenges themselves. And even better, raw material prices are stable or, in some cases, even decreasing slightly.
Okay, that's definitely good news for their cost base.
Yeah, it removes one major headache for sure.
So the core auto parts business seems solid, despite the Q1 blip with the strong order book and improving margins. But you mentioned diversification earlier. They're not just relying on auto parts, are they?
Not at all. And this is where their strategy to sort of de-risk gets really clear. They're actively building up other business lines. Let's start with their aftermarket business, which goes by the brand name Helpus.
Helpus. Right. How's that performing?
Really well, actually. They describe it as having healthy momentum. They've got over 1,200 SKUs, different product types. And the standout number from Q1 was a 27% year-on-year revenue increase for Helpus.
27%. That's serious growth.
It really is. It shows there's strong demand for their parts after the car is sold, not just for the initial assembly. They sell through about 150 distributors offline, but also online, their own site, Amazon, Flipkart.
Covering all bases.
Pretty much. And the plan is ambitious: expand the network, grow exports, and they're targeting Helpus to contribute 10% of PPAP's total revenue by FY27.
10% is a significant chunk. Are they investing in it?
Seems so. They mentioned a recent meeting with their top 35 distributors and plans to boost the helpless team size from 40 to 60 people by the end of the year. So, yeah, definite focus there.
Okay, so aftermarket is one pillar. What else is in the diversification mix? There's a tool room business?
Yes, MRAI Precision Tool Engineering.
Mm.
This is their commercial tool room. It makes molds and dies, primarily, and it serves both auto and non-auto customers, so it's already diversified in its customer base.
And how's its order book looking?
Pretty strong. They reported a 30% year-on-year increase in its order book in Q1, reaching about 30 cores. That's business they expect to execute over the next year and a half or so.
So another solid contributor.
Yeah, and they're planning to increase capacity there too, aiming for 150 molds per year.
Yeah.
So they see more potential.
Then there was the industrial product division. I think it got rebranded.
That's right. It's now called Avina Industrial Products. The idea here is to leverage their core skills, plastic and rubber extrusion, injection molding, but for non-automotive industrial uses.
Taking what they're good at and finding new markets, smart. How's that doing?
Q1 sales were apparently similar to last year's Q1, but they have a very optimistic outlook for the full year. They expect this division to, and I quote, do twice as much business done last year.
Twice as much, so they must have some significant projects lined up.
Seems like it. Suggests maybe some contracts were signed or are expected to ramp up significantly in the coming quarters. Again, fits that picture of Q1 being soft, but the rest of the year looking stronger.
Okay, aftermarket, tool room, industrial products, and then there's the battery business, Avenia batteries. This one sounded like it had a bit of a strategic shift.
Yes, this was particularly interesting. Last year, they made a clear pivot. They moved away from focusing on batteries for mobility, like for vehicles, and shifted focus towards storage solutions. Think stationary energy storage.
Okay, energy storage. Big potential market, but maybe slower to develop. How's that going?
They described it as gradual market adoption, but also steady operational progress. It sounds like they're learning and adjusting. One key change, they've stopped chasing lots of small customers.
Right.
Now they're concentrating their efforts on just 5 or 6 promising marquee customers, big potential clients.
That sounds more focused, less scattergun.
Exactly. To de-risking move within that division. And this raises the important question, right? Can they turn this business around? It's likely been a drag financially.
So what did they say about a turnaround? Are they confident?
They sounded quite confident, actually. They said a turnaround is very much happening now. They were expecting to sign some key contracts, possibly even in August 2025 when the call happened. The goal this year isn't massive profits. It's pragmatic. Get the battery business to be zero loss-making. Stop the pleading first.
Sensible approach. Build from there.
Precisely. They were clear. No big new investments or ambitious long-term targets for batteries until it's stable and financially sound. Focus on using the investments already made, step by step.
It really paints a picture of a company managing multiple fronts, a core business, growing diversification efforts, and turning around a newer venture.
Definitely a complex balancing act.
Which inevitably brings us to risks. No business operates in a vacuum. What are the main roadblocks or potential issues PPAP highlighted, both for the wider industry and themselves?
Well, for the broader auto industry, one specific thing they flagged was potential supply constraints on rare earth magnets from China.
Ah, the magnet issue, crucial for EVs, right?
Absolutely. Crucial for electric motors. So that's a big macro factor. The whole industry, especially anyone serious about EVs, needs to keep a very close eye on. It highlights those global supply chain vulnerabilities.
Okay, that's industry-wide. What about risks more specific to PPAP? They said they didn't have supply chain issues themselves and raw materials were stable. So what are their main worries?
Yeah, despite their own operational stability, the big risk they face comes from their customers. Those customer-driven delays we talked about earlier.
Right, the project deferrals.
Exactly. They gave specifics. Some EV projects got pushed back by customers because of those very rare earth problems and approvals. And some traditional ICE SUV projects expected in Q1 got delayed by about 3 months. And we're now likely starting near the end of Q2.
So even if PPAP is ready to go, if the customer isn't, it hits their revenue timing.
Precisely. It underscores how interconnected everything is. Your performance depends heavily on your customers' timelines and challenges.
Makes sense. Any other risks mentioned? What about sort of bigger picture global uncertainty, trade issues?
Yes, they touched on that too, particularly regarding the export business for their Avina Industrial Products division.
How so?
They gave a concrete example. A customer in the U.S. market has put decisions on hold for 3 or 4 months. Why? Because they're waiting for clarity on final tariffs stemming from the ongoing uh, tariff war, as PP termed it.
Ah, so trade disputes directly impacting potential orders.
Exactly.
Hmm.
It just creates unpredictability for their export plans. Hard to forecast sales accurately when your customers are waiting on government policy decisions. It's that macroeconomic uncertainty hitting the ground level.
So we have potential industry supply issues like rare earth magnets, customer project delays impacting timing, and global trade uncertainty hitting exports. How is PPP strategically trying to manage or mitigate these risks?
Well, the core strategy really comes back to that diversification we've been discussing. They were quite explicit about it on the call.
How did they frame it?
They stated that all these new business initiatives aftermarket with Helpus, the tool room, industrial products, the shift in the battery business, are all specifically designed to de-risk their portfolio from sector-specific fluctuations.
So it's not just about finding growth, it's fundamentally about reducing their dependence on the ups and downs of just the core auto industry.
Exactly that. It's a strategic playbook. Leverage your core capabilities, manufacturing, engineering, supply chain, but apply them in different, hopefully less correlated markets. It builds resilience. If the auto market has a bad quarter, maybe the aftermarket holds up or industrial products are doing well.
Spreading the risk makes a lot of sense in such a cyclical industry.
It shows foresight, definitely, and planning for bumps in the road.
So wrapping this up, what does this all mean for you, the listener? We've gone through this deep dive into PPAP Automotive, looking at the mixed signals in the auto industry, PPAP's own Q1 performance, their confident outlook based on delayed projects, and importantly, their deliberate strategy of diversification.
Yeah, understanding this layered approach, the strength in the core business, that huge order book, but also the active building of these other revenue streams like aftermarket, industrial, batteries, it's really key to getting a handle on how companies navigate complex markets today.
Absolutely. It's not just about the headline numbers. It's about the strategy underneath. Whether you're an investor working in the industry or just trying to understand the economy, seeing these moving parts is crucial.
It's about seeing those strategic chess moves, not just the immediate score.
Precisely. And that brings us to our final thought for you to consider. Beyond just the numbers and the divisions, what does PPA Automotive's story really tell us about that essential balancing act? The balance between managing short-term operational hurdles, like a soft quarter or delayed projects, and building long-term strategic resilience through diversification in a global market that just keeps changing.
It's a great question. How do you manage the now while building the next? Something to mull over.
We hope this deep dive gave you some valuable insights into that very challenge.
Hope you found it useful.
Thanks for joining us on the deep dive.